Canadian home prices are absolutely plummeting and crashing. The housing market is turning into a train wreck, and the economy is heavily dependent on it, as is the banking system. So let's take a look at just how much these markets are going down. Canadian detached home prices are plummeting. Here are the hardest hit markets. So let's see here. Canada's single family real estate market has been hit hard after years of frothy growth. A benchmark home fell to $794,000 in November, dropping 1.4%, minus $10,900 in the month. Prices are now 17.8% lower for the segment compared to the peak. The correction is now widespread across the country, with not one market still at all-time high and many markets much lower. So let's take a look at just how much these declines are. And when you think about the real estate market, you have to remember that a lot of the markets that haven't declined that much haven't declined because of low inventory. Well, low inventory can quickly change. And this is something that the real estate industry completely gets wrong. The mainstream media gets it wrong. The government gets it wrong. They all get it wrong because they just focus entirely on interest rates when it isn't just all about interest rates. It's also about unemployment. So yeah, you're likely to see like fixed rates dropping. Probably the actual rate is going to stay high until something breaks, which is getting higher and higher degree of probability this year. So you're going to see that dynamic play out over the year. But essentially, as interest rates are high, as these fixed rates come down, you're going to see unemployment go up at the same time. And unemployment has much more of an effect than interest rates. Think about it. Interest rates make the market illiquid, but what unemployment does is it forces people onto the market. It forces people to sell. It's a totally different dynamic. We know for a fact that most of the people that bought and who are underwater on their mortgage are not going to be able to pay this back. We know for a fact that the chances of somebody defaulting skyrockets as they go more and more underwater on their house, because guess what? They can't do anything about that, especially if they can't even rent it out and get some sort of positive yield, which nobody can, because these people didn't think this through when they bought. They bought just on fear of missing out, and it's been like that for years, that rents have been lower than buying a house when you take everything into account. So anyway, Vancouver peak value was 2.1 million. It's down to 1.85 million. Oakville, Milton is collapsing as well. These are all single family homes, by the way. So 1.91 million. It's now down at 1.43 million. That is a huge drop. You've got Mississauga down from 1.71 million to 1.34 million. Toronto's down from 1.6 million to 1.28 million. You've got Victoria down from 1.3 million to 1.267 million, and then you've got Ontario as a whole that is down from Ontario as a whole is down from 1.19 million to 943,000. This is Ontario as a whole. And that is just baffling when you think about like the rest of Ontario and exclude like the Greater Toronto area and all the markets that I would say are highly dependent and correlated to what happens in the Greater Toronto area, because you essentially have the people moving out, you essentially have people buying rental properties in places that are 2-3 hours away from the Greater Toronto area. So the Toronto, Mississauga and the GTA affects a lot of the other markets that are in Southern Ontario, and that's what we saw play out in 2021. And that was just amplified by the fact that people were remote working from home. A lot of people moved, but they didn't actually sell their house in Toronto. They decided to rent it out, and that turned out to be a huge mistake. And when you have this sort of herd mentality, you pretty much should have as a rule of thumb to just go against that, because I mean, that's what I do. If ever the crowd is doing something, that makes me really nervous about it, especially if it's financial. I'm always looking at what are my risks first thing, always. So anyway, Vancouver Island is down 867,000 to 772,000. Cambridge is down. That was a really frothy market, 1.05 million to 770,000. Huge declines. Kitchener-Waterloo was another one, 1.09 million down to 791,000. Ottawa's down 826,000 to 700,000. Pretty much everywhere is down, all these markets. And, Calgary's an interesting one. 598,000 down to 573,000, because Calgary's market, there's just this persisting low inventory that is keeping prices up. But if you have unemployment rise, what happens? Then all of a sudden that inventory appears, and guess what? All of a sudden prices just plummet. So a lot of these markets are the prices are staying high, and they didn't even grow that much because of the fact that some of these markets, especially like Calgary and Edmonton, they build a ton of single family homes. And then not only that, in markets like Calgary and Edmonton, you've got people that are moving from Ontario. They're not bringing jobs, because if you look at business incorporations and other metrics on the Alberta dashboard, you can see that they're not bringing jobs. So essentially, they're just going to make a recession and unemployment even worse, because they're going to be the first ones to go. Most of them are moving not to cash out of Ontario. They're moving to buy their first home, and they've just got that FOMO that they're willing to move halfway across the country to satisfy their FOMO. It's not because of politics, it's all because of housing, trust me. That's what I saw over the summer when I was playing football. So it's kind of crazy. So anyway, Halifax, Dartmouth, 558,000 down to 486,000. And I bet that's a similar sort of dynamic to Calgary and Montreal, in terms of low inventory that are keeping prices up. And then we're going to talk about BC, because we didn't talk about them the other day when we were talking about Toronto. Single-family home prices fell in over 90 of single-family price index published by the industry. The largest drop in percentage points were Simcoe, minus 4.4%, Fredericton, minus 3.9%, and Lakeland's, minus 3%. Shedding even a point in a single month is a big move, so these single-family home price declines are massive. British Columbia real estate was slow to correct, but is making up for lost time. Again, think about these markets that haven't moved that much, and think about what I've just read there. British Columbia was slow to correct, but it's making up for lost time. You may very well see this play out in other cities. I think it's just an incredibly precarious time to get into real estate, but that's just my opinion. But it's kind of nuts when you think about that. So you have to think about that dynamic. So anyway, it basically shows that Vancouver's down $35,000, Fraser Valley down $31,000, and Victoria is down $29,000, and that's monthly performance. So that is big declines. So it's quite bad. And then Ontario again, just seeing massive declines. So from the peak, Kitchener-Waterloo is now down 27.7%. And add inflation on top of that. Add 20% inflation. You're talking nearly 50% decline if you add on 20% inflation to that. And then just the thing is, it's still unaffordable for most people. That's what people just can't get their head around. Still, even at that level. I mean, prices just have to go down so far in order to get to a place which would be deemed affordable in Canada, because this bubble got so big and people just don't think, oh, that cannot happen. We cannot see 2014 prices. We're never going to see 2013 prices. Well, it could happen. And if it doesn't happen, that's likely going to be because of some black swan event / banking crisis that is going to come with its own case of problems. And if the government decides to, unleash massive fiscal responses like we saw in 2020, then you're going to see even higher inflation. I really just don't see a way in which the market can go down unless real wage growth just started skyrocketing all of a sudden. Because even in any scenario, you just have problems with inflation, or you know, there's no way out of this. There's no way out of this. Like I said, the only way out is real wage growth just skyrocketing, and I don't think we're going to see that. So Cambridge minus 27%, London St Thomas minus 26.7%, should I say. So Oakville, Milton down nearly $500,000. You know, all the declines are there. You can look them up if you're interested. One thing I wanted to show you guys, because the real estate is really good. The real estate industry, the government, the mainstream media, they're all going to focus on this. And they're going to focus on interest rates. They think it's interest rates that are essentially the driver for the housing market. And again, it's that recency bias. It's because we saw 2022, housing prices came down because interest rates went up. And they are a major contributing factor, not going to lie. They do contribute hugely because they bring down demand. They make the market more liquid. So any sellers that need to sell, they have to bring down their price, and that causes prices to come down. However, what the real estate industry isn't seeing, as usual, is the fact that when these interest rates start to come down, that is going to be because the Bank of Canada is cutting, likely because there's problems in the economy. For example, unemployment is starting to really ratchet up. And in that case, unemployment is going to be having a much bigger effect on the housing market than the interest rates. And the Bank of Canada is always going to be behind the curve when it comes to what they do. So think about what they did with inflation in 2021. They just sat on their hands for so long, didn't start raising rates until spring of 2022. So you know that the Bank of Canada is going to lag behind. That's if you don't see a black swan event or a banking crisis. The probabilities of that happening just keep increasing as long as rates stay this high and asset prices continue to decline. So you have to bear that in mind. The probability is just keeps increasing of this black swan event, banking crisis. And again, what sort of problems is that going to cause for unemployment and other things? We saw in 2008 in the US how when they dropped rates down to the floor, housing prices continued to decline for 4 years. And when you look at typically how long it takes for these housing declines, like after these bursts when the housing market goes down, it's typically 4 to 5 years. But in the case of a super bubble, it could be much longer, like Japan. You could be talking 10, 20 years, but you could be talking extreme declines for a couple of years, and then it's just like no actual real growth. So inflation adjusted, prices are negative essentially. They might be up slightly, because I don't think inflation is going to be coming down to 2% unless there's a massive depression, at which point we will be looking at other things that will be having a massive impact on different areas of the economy. Obviously, inflation will be the least of people's worries at that point. So you can see interest rates, unemployment, weekly earnings, these aren't adjusted for inflation. Those are the things that affect your housing market the most. It is not just a single one. The real estate industry just seems to focus now on interest rates. Like if we see fixed rates come down, that's going to mean housing prices are going to go up. It's more complicated than that. But as usual, these people just are essentially brainwashed, and they don't understand that markets are complex. There are more things going on than just pointing to one thing and saying, this is the cause. Obviously, this is the cause of the drop in demand. This will be the cause of the inventory rising rapidly, is when people are forced onto the market. And then this is the thing that you need to watch, because if average weekly earnings suddenly ratchet up, which is unlikely, in fact, they're more likely to come down because of recession. So the opposite is more likely to happen, that even though inflation's coming down, weekly earnings are also coming down. So you're still negative wage growth. And this is just something we didn't even see in the 1970s. This wasn't a major problem. In fact, it was the opposite problem. Wages were rising too quickly. So, there is huge problems that we have in 2023 that are much worse than what happened during the 1970s. So it is kind of interesting. And then we'll just end on this real quick. This was January 14th, 2022. I just want to share this with you. This is what the real estate industry said. Many industry watchers expect the inevitable rise in borrowing costs will abruptly end the current seller's market with its characteristic rising home values. SOPA said we are experiencing the first expansion housing cycle, which began in the second quarter of 2020. Since the introduction of the federal mortgage stress test, buyers have had to qualify for a loan much higher than what they would actually pay, creating a significant buffer before they reach their capacity to manage larger payments. It's hilarious looking back now in hindsight to read this stuff. While interest rates slow house price appreciation, higher borrowing costs will be coming off historical lows, and the increases may not be enough to offset the significant upward price pressure from Canada's housing supply crisis. Because again, they always focus on supply. They always focus on interest rates. They can't piece it all together. Their minds just can't do it, and I don't get it. It's just kind of funny to me that this is the way they work. But, obviously markets are complex. Different things can happen. I'm no financial expert by any means. All of this is just my thoughts and opinions, just as somebody who thinks critically and who thinks logically, which is hard to find, I believe, in 2023, and has been hard to find for a long time. And I love speaking to you guys in the comments on these videos, because I know a lot of you guys are like that too. So anyway, if you enjoyed this video, you might like this one there. You might also like this one there. And I'll see you in the next one. Take care of yourselves, everyone.